we get ready for a big earnings week. It's going to be a fantastic lineup here on the TD Ameritrade Network throughout the day. I'm Oliver Renick. Welcome. We're live from the Nasdaq market site. And it's a good day to do it because markets are pretty wild once again. We're talking about the 10-year yield pushing towards 3% overnight. We're going to talk about bonds. We're also going to talk about the focus that's happening right now on stocks because we got a whole bunch of folks joining here in New York today to help us make sense of these markets. It's volatility and it's earnings season, separating out the winners from the losers. We're going to have one guest here, Ben Axler from Spruce Point. He's going to give us what he deems to be one of the latter there. We're talking about Mercury Systems, targeted recently in a report by Spruce Point. We're going to get into that in detail, talk about what the company needs to do to get out of the doghouse as far as Spruce Point sees it. But we're also going to take a look at some big earnings topics from CEOs, as well as those specific FANG numbers, because Google's out this afternoon. We've got two CEOs that are going to be here to join us to talk about their companies. TD Ameritrade's Tim Hockey is here, as well as William Karstanjian of Churchill Downs. He'll join us after ringing the opening bell at the Nasdaq. We're going to talk beyond just, of course, the Kentucky Derby. We're going to look at the gambling industry overall. And then Tim Hockey is going to join us to talk about what comes next for TD Ameritrade after that Scottrade acquisition that closed and converted earlier this year. But back to earnings, because FANG is on the way. We're going to see if Google, parent Alphabet, can report some numbers that are going to help the FANG suite, because right now, as markets get volatile, those stocks aren't doing a whole lot to keep up their weight. We'll find out if earnings can be the answer. Right now, so far, companies are beating, but they're also getting sold off as a result. This morning is no exception. Hasbro, Halliburton reporting. We're going to get into those in depth, but also get a preview of what you need to know for those Google earnings after the bell. We got tons here, as well as a deeper dive into perhaps what it might take to be a hedge fund manager. Maybe not the CEO, but the COO can be a dirty job. If you're like me and you watch Showtime's Billions, you're going to be excited because we're going to get some inside scoop on what it takes from Wags himself. David Costabile is going to join us here in studio to talk about how he's learned about markets and how the show might continue as these markets get pretty rocky. But mostly, we're going to find out how he got into some of those very interesting lines on the show. I'm excited to talk with Mr. Costabile. We got plenty ahead on this program today. I want to get things started, though, by taking a look at the bottom line picture that's breaking this morning. Earnings kicking things off for a very big week. It's tech-focused, but right now we got some interesting stocks as well. Hasbro and Halliburton reported before the bell. Kevin Hanks is joining us from the Chicago TD Ameritrade newsroom this morning to help us take a look at this. But first, I want to take a look at the broader market overall to set the stage. We've got a few items here that we've been looking at. Of course, the year-to-date move in stocks has been pretty rough. We're a little changed on the year, but last week things were looking positive, quickly turned south on Thursday and Friday. We'll see if those earnings can assuage investors' concerns that this chart is going to remain rocky, because as you can see there, we're talking about a divergence between some of those small caps and the big cap companies. The tariff talk kind of has taken a back seat, but it also might come back into play this week, because news over the weekend that Treasury Secretary Steven Mnuchin is going to be heading over to China to perhaps get some bottom line answers on what comes next for trade. But again, let's get to those earnings, because that's where the story is. This morning we had Hasbro, we got Halliburton. Last time around, this is an interesting start to earnings. Kevin Hanks is here with us. Kevin, let's talk here about this market first, because the big story I see is the fact that 10-year yields are getting close to that 3%. Is it finally time to break it, Kevin?
You're exactly right, Oliver. The big story coming out of the bond market this morning is the approach towards 3% in the 10-year yield, 2.966 as we start the day here, Oliver. You know, it's significant and a very psychological number. I'm not really sure how important it is for the overall market, but in terms of direction, lower bond prices lead to higher yields, that's for sure. In terms of 3%, it'll be a psychological number, not much more than that.
All right, not much more than that, Kevin. I thought we've been waiting on pins and needles for the past year and a half, and now we're finally getting close. We were talking about it last week,
sure,
right? It looked like maybe some of those folks that were real short into the bond market kind of covered. We got stuck in this range. The fact that now we're coming back with such velocity, does this look like February again, or does this look like potentially something different?
Well, coming out of the March 21st Fed meeting, there was a normal knee-jerk reaction, and bond futures went up, yields came down soft a little bit. It hung around a little more than some investors would have thought, but now we seem to be back on that long-term trade, which is lower bond prices, higher yields, creeping now towards 3%, Oliver.
All right, Kevin, let's talk earnings. I know that everybody's focused on Google. Yeah, that's the big one. I'm ready for FANG too, but let's not forget some of the smaller guys. And not necessarily small. We got Hasbro and Halliburton,
Sure.
though Hasbro seems to be getting smaller by the day. Kevin, what was so rough about these earnings? The last I looked, the stock was on its way to 10% lower in the pre-market, trying to come back. What's going to determine whether it does on that bottom line?
It looked like it's down about $4. It missed on earnings, it missed on revenue, and it tails much like the Sports Authority effect on Under Armour about a year to 18 months ago, Oliver. The Toys R Us bankruptcy is really affecting Hasbro's ability, hurting their sales, hurting their profits. It's a very similar thing. They need places to sell their products, Oliver, and the Toys R Us bankruptcy really seems to affecting. They're also talking about the tax cuts are affecting their overall business. So a lot of things going on there at Hasbro. Not much good news to come out of these numbers, though.
All right, Kevin, Halliburton, last time around in the earnings season, this stock has continued to beat up since. We know the energy is trying to make a comeback, though. These numbers show us that perhaps it's sustainable.
Stock up 10 to 12% in the last 12 months, Oliver, but a little softer this morning. They had an earnings beat. They swung to a profit, as you know, but in this environment, where expectations and earnings are really so high, the stock's just a little bit softer based on those earnings. All in all, though, numbers that Halliburton can be proud of and a beat, just not as enough for this environment. Stock a little bit softer as well.
All right, Kevin, not so great. This continues to be a story in which no matter what companies do, the shares seem to be dropping. Kevin Hanks, what a better way to make me feel at home than getting us started here from the Chicago TD Ameritrade Newsroom studio. Kevin, we'll chat throughout the day. All right, of course, as Kevin mentions, we're just talking about it is earnings season, and investors have been less than forgiving in this market. The average company has beat expectations, but the average company has also declined after reporting. We want to take a deep dive into one stock here that investor Ben Axler says has rough days ahead of it. It's Mercury Systems, and Mr. Axler, founder and CIO of Spruce Point Capital Management, joins us here at the Nasdaq market site. Ben, great to chat with you again.
Thank you for having me.
Let's talk Mercury Systems. Set to report tomorrow, and you guys put out a report about this last week. Tell us what you see that has issues within this company.
Sure. Well, we see significant financial strain in Mercury. It's pretty evident looking at the numbers. For 3 years, they've grown their adjusted EBITDA by over 100%. Their cash flow hasn't grown and it's declining. Now, management is purely incentivized to move that adjusted EBITDA. We've noticed more aggressive accounting in the business. They use percentage of completion accounting, which allows them to move to accelerate revenues, defer costs. What we're also noticing is extreme turnover in the management team. The chief accounting officer, the treasurer, the CFO all resigned. What did they do before resigning? Put in place a stock sale program to sell their equity at an all-time inflated high multiple.
Don't they typically put a timeline that they say we're going to get rid of these shares? Is it atypical to see that happen, or is this something they lined up ahead of time? Isn't that sort of the norm that you should put those out, those notifications that you're going to be doing that?
Sure. Well, we have a problem with that. So they didn't file an 8K saying that they were going to put in a 10b5-1 stock sale program. What they did was file a Form 4 3 months later, and then at the very bottom put a footnote that's saying 3 months earlier in August, they decided to sell stock. Now, the timing of this is all very unusual. One of their biggest programs, the Surface Electronic Warfare Improvement Program, is showing signs of strain. The government audited that program, found significant cost overruns.
This is the Navy program.
The Navy program. This time last year, they reported almost 18% of their revenues tied to that one program. We think that that program is getting delayed. There's problems with it. That's going to create a big hole this quarter if they can't fill that, nearly $25–30 million of revenue this quarter.
They recently did a transaction as well. But I want to talk about something here that is, so this is a defense supplier, right? This is an aerospace and defense supplier, government contracts, as you mentioned, with the Navy. What I'm curious about is when you talk about programs like the F-35 that they have exposure to, Patriots, I mean, aren't these items and equipment that is something that provides that kind of constant need for revenue? Where then does this go south? I mean, is that not a sort of a backstop? I would think that that exposure is pretty solid.
Well, there's some lumpiness in these programs that don't necessarily book the revenue evenly over the quarter. Some of these programs can be delayed. In the case of the SC Suet program, we do think there are delays there, and that's causing an issue there. And there's customer concentration here, okay? Let's not forget some of their biggest customers are the primes. As they grow, you refer to the fact they did an acquisition. As they grow, they're going to lose their small business designation, which will make them ineligible for certain business with the primes. We think the primes do business with them because they're a smaller business and there's less compliance costs. So that's a material risk that's not being factored into their current share price.
So I look at this stock, and some of these things sort of leave a trail of what looks like a very normal type of growth from a company that at one point had negative earnings, and then those negative earnings shrank, and then about 3 years ago, 2015 to 2016, correct me if I'm wrong, that then profit turned positive. Does that not sort of look like the similar pattern that we see for a lot of companies as they grow, as they go from revenue to actually putting money to the bottom line?
Well, there's no question the earnings have grown and the cash flow has grown. The company's in slightly better shape than it was a number of years ago. We are in a defense cycle, but investors buying in right now at $45 a share have to ask themselves, what are their return expectations going forward? You have a multiple here on the stock that's at a decade high. You have all the signs of strain in the numbers, and you have insiders selling, which is always a key signal when you see them selling. Usually you want to file trail.
The chart that we just had up from your report, I think, is very interesting. That I think speaks magnitudes. One is a chart that shows just how expensive the company is by several metrics on valuations relative to its peers in the space, and it's on the very high end.
Sure.
And then when you take a look at the actual cash flow, which is what you're talking about, it's way on the other end of the spectrum.
Correct.
I mean, do you know where that then money is going? Do you know how that gap comes about?
Sure. So, I mean, the cash flow is struggling. It's not growing. In fact, it's been trending down over the last 12 months. If you look at what the best companies in the industry trade at, they trade at 20, 25 times multiple of cash flow. If you put that same multiple on Mercury, you would see 75% downside. And, there's a lot of valuation distortion in the mid caps and the small caps. Mercury, we think, is a prime example. And investors, with the smaller companies, there's unique risks. The biggest risks are customer concentration. In this case, them losing their small business status is a material driver that's going to really force down their earnings.
Interesting. There's also a story here with this company that is about growth, and that's essentially why I guess investors would pay such a multiple relative to its peers.
Sure.
Then what is it about this company that makes you less forgiving to say this is a growth period? This is about taking the top line. I mean, we look around the market and there are plenty of stocks where investors are willing to say, hey, you don't have a lot of free cash flow, or maybe you don't have earnings. For them, they do have earnings. The cash flow part is where you see that gap becoming concerning. But what's the difference between this and, say, a tech company, or this and, say, a stock that is trying to build that top line revenue and then will find a use and find that synergy later on?
Sure. Well, we're finding the market becoming a little more discriminating about the quality and the driver of the growth. In this case, Mercury's growing by acquisition.
For everyone, really.
Right. Mercury's growing by acquisition. Interest rates have been low. Now interest rates are rising. Their growth hasn't been self-funded. So they had to borrow $190 million on their line of credit to do this deal.
Okay.
The CFO just resigned. They're going to need to issue equity. Unless they can come up with long-term debt, their historical practice has been to dilute shareholders. So we expect that to be...
They don't have a lot of debt on the balance sheet right now.
No, they do. They have $190 million. Plus they have leases. They've expanded their footprint. So we think the adjusted debt to the actual free cash flow in this business is over 7.5 times, which is not a thinly levered company. It's fairly highly levered.
Okay, last point, as you talk about issuing shares, that means lower prices. Just real quick, confirm, what's the target level that you're looking at? Is there a place here where this company makes sense in terms of stock price?
Well, I mean, we think this thing could go down 70%. I mean, why would we pay 40 times multiple for a cash flow multiple for a company that hasn't demonstrated any cash flow growth in 3 years, when I can go buy Lockheed Martin, Northrop, I can get a dividend from them. They're buying back stock.
Sure.
Mercury isn't paying a dividend, isn't buying back stock, has unique risks that aren't being discounted into the share price. So, we see material downside here.
All right, Ben Axler, Spruce Point, thanks so much for joining us.
Thank you very much.
Appreciate you coming in. Ben Axler, CIO at Spruce Point Capital Management, talking about Mercury Systems, MRCY. We got a lot on earnings coming up, though. We're going to take a look at some of the bigger picture story that is happening for stocks and the markets as a whole. We're going to talk ahead with Tim Hockey, the CEO of TD Ameritrade. But until then, we're going to get an update on these markets with the Chief Market Strategist, JJ Keenan, and Executive Vice President of Trading, Stephen Quirk, right here from the Nasdaq market site.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity, Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets, born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
TD Ameritrade Network goes to the Nasdaq.
Expect knee-jerk rallies too.
The voices you know.
They're selling upside calls to buy downside puts.
I think it's a fairly safe bet to bet on the American consumer.
The questions that don't get asked.
They have nothing to gain.
All markets, all day, streamed across all social platforms. Only on the TD Ameritrade Network.
So, Lionel, what does being able to trade 24/5 mean to you?
Well, it means I can trade after the market closes.
It's true.
So all
Evening long.
Ooh, so close. Yes, but also all.
Night through its entirety.
come on, all
The time from sunset to sunrise.
Right, but you could trade.
From darkness to light.
You're not gonna say it, are you?
Welcome back to Morning Trade Live from the Nasdaq market site. I'm Oliver Renick. We're talking about markets that are set for a whole slew of earnings this week on the stock side, and also some potential bears coming back into the bond market as yields hover around that 3% level. I want to welcome in two guys that are regulars on Morning Trade Live. JJ Kinahan, the Chief Market Strategist at TD Ameritrade, and Steve Quirk, Executive Vice President of Trading. Morning, guys.
morning.
Morning, all.
Congratulations.
Thank you. Same to you guys. Let's talk here about what's happening this morning, because we were talking about hitting all these earnings, talking about the slate that's coming from FANG stocks, but then we wake up and now we're back towards that 3% level. I mean, is this time for real?
I got to give you a little credit, Oliver. You've been calling for this. You've been saying we're going to breach this.
It seemed like last week things were kind of heating up on the other side, where you got the jitters out, first test, and then all of a sudden this data starts to come in weaker around the world. You know, what else then could keep it lower? What happens here, JJ?
I still don't think we go through 3%, to be very honest with you, Oliver. And the reason I say that is because, you know, how the markets come back a little bit here in the pre-market. VIX was a bit higher, has come back off that a little bit. So we may, I do think we're going to test it, and you and I have talked about this a lot. Maybe go through it temporarily, but I think we're going to have a very difficult time holding that 3% level.
It's a meaningless number, but for some reason it means a lot to, you know,
psychologically.
it is psychologically.
The end of the bond.
It is, because it's really a signal that says, you know, what everybody has been fearful of, and we've seen a couple spasms of this, is that we're going to move with the velocity that people aren't comfortable with. It's everybody's fear, and you know, I think when you get over 3, then it becomes a different conversation.
I think that's an interesting point, because we've been hearing about this for the better part of a year and a half, right? The bear market in bonds, it's coming. The higher interest rate environment, we've been hearing that back since 2014, 2015. But if indeed we move through this level, does that sort of symbolically say this is that new environment? This is an environment of volatility that's now complemented by higher yields?
Absolutely. You saw the market, you saw yields basically for 30 years go lower. And now it's the ultimate trending product. And now we are turning the other way. And what's interesting to me is we've had so much fear around, oh my God, 4 moves. Sure. This year, it'll be interesting to see what effect it does. If we go through 3%, I think that's the signal. It's 4 moves this year, guys. Get used to it, and we'll see if people get afraid of it.
Yeah, because if you look at even since April, I think they're at 24% probability of 4 moves. Now it's 38. It's almost 40%. So there are people that think this is happening.
So then what, overnight, over the weekend, from last week, the reason why we were kind of talking about this a week ago, saying things could arguably do feel a little bit different.
Right.
For me, it was largely looking at some of those cases for why things like the dollar had stayed low and why there was still sort of a reticence to sell bonds off in a very rash way. It was because there was a lot of good things happening in terms of economic data around the world. So then, you know, why would we have to sort of push these markets in that direction? But some of that has softened up a little bit. And then the U.S. really becomes that sort of stronghold once again. I mean, what then are those sort of factors that will decide, JJ, if that trajectory moves higher for yields.
So I think the one thing you have to keep in mind is we're still not going to decouple completely from what's going on in the rest of the world.
Sure.
You have to remember, you have Germany at 5/8% at this point. So
as long as those are low, it's hard to see.
It's hard to see us going to 4% when they're still down here, and I don't know if those economies are healthy enough yet to really take that higher rate. So I think that's something you have to keep in mind that's very important. But the other thing is I think it's really interesting that this happens during earnings season. We just came up that 3 weeks of no news when the market was all over the place. Earnings have been solid. So this is the time you want to see things move up like that because the market can absorb it, because even though we're not having the positive reaction to earnings as many of us expected, so far we're having a very good earnings season.
Yeah, but if you marry those two things together, basically what's happening is 80% of the firms have beat, and they're going down.
Right.
The expectations are much higher. So
Looks
you
like we
couple
talked about,
that,
right? Valuations sitting at that 30-year average.
Yep.
Companies, they'll have big expectations to fulfill that.
Yeah, we have a third of the S&P reporting this week, and the expectations, they have much higher expectations.
Yeah.
They would be happy to hold their current stock price with their better than forecasted earnings.
Yep.
Marry that together with the interest rate environment, and there's an expectation for growth that is probably going to, of course, lead us to a higher interest rate at some point in the near future.
What's interesting about this is that what are we going to sort of look at outside of just the 10-year yield, outside of just stocks? If you remember back in February when this happened again, right?
Yep.
We had the wages number, yields rocketed up, markets sank, but amid all that, there was this curious sort of flatness in credit spreads. You didn't see a big sell-off in junk like you saw really at the start of the year. That kind of happened in January, and then it just kind of flattened out in terms of the high-risk bond market. What do we need to see happen to confirm that perhaps there is a shift, or that there's something fundamental that's concerning, or if the market then can kind of go its own way, say, hey, higher yields, okay for risk on, okay for stocks. We can live in these two in harmony, if you will.
And I think you're getting it right now from what the CEOs are saying about forward projections. You know, you got to remember a lot of these numbers we get. Like you look at housing, and we talk about housing a lot because I think it's incredibly important in terms of a confidence barometer for the market. But they're always in a lag. Even earnings are in a lag. So what I look to is say, what are the CEOs saying about earnings going forward? What are the CEOs saying about tariffs? The amazing thing to me is we still haven't heard any tariff talk out of these CEOs, and I think that's one of the big reasons that the market's hung in there. You may not get the rocket up, but we haven't really seen hard sell-offs, and the reason being because I think the tariff talk has been muted significantly by its lack of appearance in the CEO conference calls.
Yeah, well, I don't know that they fully understand it yet, and I don't know that they want to get in the middle of that.
What is there to understand, right? We've got to get some words on paper, and we might, because news over the weekend, Treasury Secretary Mnuchin will be heading to China to try and iron out that situation. But let's talk about some companies, guys. Kevin and I just hit the top line for a few I want to revisit with you.
Sure.
Hasbro, once again, having problems. This just doesn't let up on the downside for the stock. Is this a company that is going the way of Toys R Us, or can it break off from that pain and find its own market?
You know, it's interesting. Steve and I, on the way over here today, Steve said, well, I don't know why Hasbro and Mattel just didn't buy Toys R Us.
They should have. They have no distribution.
You know,
go ahead.
No, please.
When you take away your major distribution network, I don't care how good you are, because the CEO and CFO got on there today and said, we're still solid as a company. Well, that's awesome, but if you don't have a way for people to buy your toys, you don't say solid real long.
And by the way, it's very different. You know, we're both people with too many children, and those are point of purchase. You know, this isn't something that you go on Amazon and the kid says, "Oh my God, I want that." You know what I mean? They want to touch it, feel it, and play around with it.
Kevin brought up an interesting point, which is an analogy between Under Armour and Sports Authority, which closed up.
Great analogy.
And Hasbro versus Toys R Us. But the interesting thing here is that Under Armour made a pretty nice little comeback. And Under Armour, within this retail rally the past 6 months or so, has done solidly. What's going to determine if Hasbro can take a life of its own?
I guess the thing I would say that probably is a little different is I would say it's easier for somebody who's an adult or somebody who needs exercise equipment to look and purchase things online as opposed to a 5-year-old child that's looking for a toy. I don't know that that's there's a bit of a difference there.
I would say the one other thing is Under Armour's done something smart. They've opened up some Under Armour anchor stores in big cities, so that you can even go to the big city. There's no Hasbro store or Mattel store that I'm aware of, and I think that that's actually a big difference. They're a portion at Target, a portion at Walmart. They don't have their own sort of branding. Under Armour truly is its own brand.
Yeah,
but I think they're bright enough and they understand this.
They've got good deals. They're going to find partnerships, right? They have some brands.
Yes.
But you're right. They have deals with other brands and other identities. Let's talk Halliburton, because I want to move through a couple others. You remember when you and I talked Halliburton last quarter, the stock looked like it was going to move up and then just went on this descent with the rest of the energy companies to try to make a comeback with that group. The numbers here, another case of meeting and market not happy with it.
And I was actually surprised that the market wasn't happy because they set out a really nice picture. Business up across the board except for Latin America.
Right.
They see business
Which
growth.
I think was expected too.
It was expected, but the Latin American business wasn't as bad as some people had thought it would be. And if you look in Asia, it was better than people thought it would be. So I struggle with this one a little bit because, theirs and Schlumberger's earnings last week, I thought the statements were pretty similar.
The services are having having a tough time.
But
even
if
as oil
memory
comes
serves
back.
me correctly, they're both up 10 to 15%.
Sure.
So
Oil rally the past couple weeks.
if they can hold what they've already gained, I would call that a win.
Another one, Alaska Airlines I want to hit before we let you guys go, because this has been a pretty impressive quarter.
Very impressive.
For just remember, in January, as the last earnings came through, we talked about concerns about adding on capacity, what that would mean for margins and price war potential. United Air got everyone worked up, and suddenly another company here actually trimmed capacity a little bit, is what the headline I took away from Alaska.
Well, what I think is forgotten about Alaska is how smoothly they've integrated Virgin.
Yep.
And so, people forget that this was a big deal. You don't hear any news about it?
Sure.
You know why? Because they're doing a great job. and I think that's really important when you start to look at something like that. And again, this is during rising fuel costs, we'll have to keep an eye on that because I think that's going to be the wild card as we saw from Delta's earnings and all these.
Yeah, but the ones that have hedged appropriately, last year in 17 they were taking charges. All the airlines were because they hedged at a higher price. They won't be taking charges.
Shares are
That'll
moving
be
up.
dropping to the bottom line if they've hedged.
Shares are moving up a little bit, about $66 this morning. Last point here, within those airlines, we talked about the trucking companies, the transports, the trains, and the airlines. If all their input costs are basically going up from oil to everything else, the fact that they can continue to deliver, I think, speaks loads about whether or not companies will be able to withstand a higher rate in a higher inflationary environment.
Absolutely, and they've done an amazing job of keeping costs low for the flyer, so their load capacity stays very, very strong on every flight.
Yeah. Last thought, Q?
Yeah, I would say you're seeing a little bit of cancellation bug with Southwest to inspect those engines. I know that they've been canceling quite a few flights, and they're providing refunds to the flyers. So my wife just got one because her flight got canceled. So I think that again, I don't think that's going to be meaningful.
There's idiosyncratic risks.
There are small idiosyncratic, but those are probably across the whole, the whole spectrum of the airlines because they all are using, if you're flying a 737, the chances are very good you're using that engine.
Right, the GE engine. Yeah.
Yep.
All right, gentlemen, we got to leave it there. Some earnings wrap up from J.J. Kinahan, the Chief Market Strategist at TD Ameritrade, as well as Executive Vice President of Trading, Steve Quirk. Guys, great to have you here
Thanks,
in
Oliver.
New York.
Thanks for having us.
Thank you, guys. All right, we got a lot coming up. We're going to chat with some folks right here at the Nasdaq, getting a little insight on how small investors might be able to use some big data. Stick around. Lots more ahead as we get warmed up here on Morning Trade Live, and we look at the opening bell. Churchill Downs, we'll be talking about that stock as well shortly ahead. Stick around. Plenty more ahead.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
TD Ameritrade Network goes to the Nasdaq.
Expect knee-jerk rallies too.
The voices you know.
They're selling upside calls to buy downside puts.
I think it's a fairly safe bet to bet on the American consumer.
The questions that don't get asked.
They have nothing to gain.
All markets, all day, streamed across all social platforms. Only on the TD Ameritrade Network.
We just got married.
We're all under one roof now.
Congratulations.
Thank you.
How many kids?
My 2, his 3.
Along with 2 dogs and Jake, our new parrot.
That is quite the family.
Quite a lot of colleges to pay for, though.
A lot of colleges.
Okay, you get any financial advice?
Yeah, but I'm pretty sure it's the same plan they sold me before.
Well, your situation's totally changed now.
Right?
How about a plan that works for 5 kids, 2 dogs, and Jake over here?
That'd be great.
That would be great.
That okay with you, Jake?
Get a portfolio that works for you now and as your needs change from TD Ameritrade Investment Management.
Welcome back to Morning Trade Live on the TD Ameritrade Network. There's the opening bell. William Karstanjian, the CEO of Churchill Downs, owner of the Kentucky Derby, opening up trading for us on this Monday, where markets are set to react to a lot of things, from stock market earnings to, of course, that 10-year yield. But we're going to talk a little bit of big picture here, because big data has become critical to just about every industry, with financial markets and investing no exception. To get a closer look at the data that runs financial markets, now average investors might be able to leverage same tools as the pros. I want to bring in Bjorn Seaburn, Executive Vice President and Head of Global Information Services at Nasdaq. Bjorn, great to be here.
It's great to be here. Thanks.
I usually say thanks for coming, but in this case, thanks for having us.
You're welcome.
Let's talk here about Global Information Services. Of course, everyone, we just look at the opening bell. We associate Nasdaq with the exchange. And tell us what exactly your part of the business does.
So I run our data and index business. So it basically consists of 3 components. So traditional market data, so data that retail investors look at when they're trading US equities, US options, or even our fixed income market in Stockholm. Then is our index business. So when you're looking at different indices, quite often we calculate that on behalf of firms, or the most known index is probably our Nasdaq 100. And then the third part is more alternative data, fund data, what we call investment data.
Yeah, I imagine that in the world of index investing, passive investing, this has become a huge priority and a huge business as investors want to use these tools. What is sort of the most exciting part about that market right now? Because it's been happening for a very long time. The growth in this type of investing continues to grow. Can it continue? What do you have to do to keep that market engaged?
So our index business is a fantastic part of the business, and we work with more or less all the big ETF issuers around the globe. Some of them have needs for just a standard traditional index calculation. Some of them have needs for more sophisticated index, and we help them with that. So robotic index is something we created together with First Trust last year. So we help quite many of the ETF issuers with new index ideas, and then they'll launch ETFs. We also see another very interesting trend, the need for ETFs globally.
Okay.
So the trend started in US, but we see more and more demands for ETFs.
Does the growth of that business then come around the world now? Is that sort of the next phase?
Yes, you're spot on. That's the next phase, and it has 2 dimensions. It actually retail customers globally, they want to trade the US ETFs, or sometimes they want to have the ETFs listed locally so they can trade the ETFs in their own currency.
Yeah. Can you give me some insight as to the institutional or retail breakdown? I know it might be a hard number to put your finger on the spot, but what's interesting is we have so many investors on the program, right? We talk about their funds. We'll say, yes, we use, instead of trying to create our own momentum or minimum volatility strategy, they'll go and they'll find the ETFs that recreate those sort of factor type strategies. So it's now gone from the retail buyer who can just get broad exposure to an index to a more sophisticated investor or big money manager. Where does that balance sit, and where does the growth come from going forward?
It's difficult to give you an exact number, but
Sure.
I think where we see a lot of growth is also for new ETFs. So it's not only that we have already thousands of ETFs in the US, but we see a need for new ETFs, actually more need for new sophisticated ETFs.
Okay.
So it's not only copycats, it's actually new index ideas that will turn into new ETFs.
Thematic ideas,
Yes.
the factor type investing,
Yes.
that stuff?
As I mentioned, the robots last year we launched together with First Trust is a good example of something new that is following the trend.
This is cool because the thematic type of investing has become very, very popular, right? We talk about it for investors that want to try and get exposure not just to a sector, but companies whose revenues match a certain industry. Or right now we've been talking about some of the blockchain related ETFs, excitement around concepts that then can get distilled into an investing style. I wonder if that type of trend will continue. if markets remain volatile, if markets then turn to not just the sort of up and away markets of the bull market, but something that gets rocky where investors say, you know what, maybe I don't want to get broad exposure, even just to an index or a theme or a sector, and I want to actually give my money to an active manager. I want to give my money to somebody who's going to hedge. What will happen in that bear market? Will that type of decision have to be made by investors?
Yeah, we see that, but I still need to stress that where we see great momentum, that is the Nasdaq 100 ETFs.
Yeah.
So even though it has been around for many years, that is actually one of the key things that people are asking for, and we see it as strong demand for actually access to Nasdaq 100, as I indicated, not only in the US, but also outside in US, and that's probably the area where we see from an index point of view that we see great demand.
Let's talk about the data side, because there's a big question about big data being used, where it goes, and that's obviously not excluding, of course, the financial industry. And at the Nasdaq, you have access to so much information, so much data. How do you provide that to not just the sort of large investors, but also that retail side as well? Because I know this is something that you guys are interested in and sort of have a market with, just giving that data and being able to use that data from really just an average investor's perspective.
So first of all, I think it's fantastic that TD Ameritrade and some of your peers actually provide fantastic data to the retail customers, so you have the chance as a retail customer to look at the order book, look at the depth in the order book, so you have access to much more data than you had 20 years ago. So the fact that data is much more accessible for retail customers is very important for me, and I think it makes it easier and better for the retail customers to trade. Okay. So I think that's a very important point, that the access to what you call traditional exchange data, looking at the order depth, bids and offers, it's much more accessible. Yeah. The second wave is alternative data. Look at new big data, alternative data that we are, together with firms like you, are also looking at, are the type of data that we could help the retail customers getting access to, which today is more accessible for the big hedge funds or the bigger banks.
What do they need? What are the tools that one can give them to be able to keep up? I mean, there's so many different things that have kind of, I think in the past decade, even the playing field, if you will, between the active managers and the big sort of Wall Street fund managers versus the retail. I mean, part of it is just data and research showing how much the passive market has been more rewarding than the active market throughout this bull rally. Some of it is within the data and the transparency. What do those retail clients need? What are the tools that can help them catch up?
So some of the things that we are working with is trying to collect third-party data. So data around sentiment, social sentiment. Yeah. It could also be weather data, could be different kind of data that is relevant for your investments in equities. Right. So we team up with third-party providers. We gather that data, we normalize the data, we look at the data and try to see if there's prediction in that data. Mm-hmm. And that's the type of data that we try to collect and then distribute. And we do not only want to distribute it to the big hedge funds, but also something that we want to distribute to the average investor.
I think that you bring up the social data is fascinating, because the sort of transparency and the liquidity of information seems like it is at an unprecedented level, in the sense that with the advent of social media, there is now a way to gauge sentiment. There's now a way to gauge what people are thinking on a sort of holistic viewpoint. And in many ways, I see that cropping up a lot in terms of analytics and in terms of data. And that's something that, of course, was not there, say, a decade or two ago. How important has that growth of social been, and getting all that information and all that insight out into the public sphere to sort of leveling that playing field we're talking about?
But think about tweets. Yeah. If you tweet about an equity here in US and you have thousands of retail investors doing that every day, right, and have that for 5 years, then you have a really interesting data set. Yeah. Is the sentiment high on these equities? What does it tell you? And if you have 5 years history of that, it will help you predict what will happen to that equity tomorrow. Mm-hmm. So gathering that data, normalize that data, and try to predict based on that data will help you as a retail customer make smarter and better investment decisions. Sure. And that's the journey we have started with the launch of Analytic Hub, alternative data, third-party data that then we gather and distribute.
It's so interesting to see that liquidity that social media provides on so many ways. I know that you guys also think about this from the IR perspective, how companies can communicate with their investor base, but also with the actual users of their products, because with that social media, you have feedback. We were just talking about airlines. There's probably not a better example than how people can communicate directly with companies. But the fact that then you can take that and use it from the investing perspective, I think is fascinating. How does that continue to grow and develop?
So I think we launched Analytic Hub, which is gathering alternative data and distributed with 4 data sets. We have now doubled the data set, and we just see more and more data sets that we want to onboard. And basically, you should see this as a platform where we actually gather that data and distribute it towards customers, firms like you, and then you can distribute it to retail customers. So I think we have just seen the beginning of third-party data, and we are just the beginning of that journey. And what we'll see going forward is also something that the retail customers will use. We see the big hedge funds use alternative data today, but it's also something for the retail customers in the future.
Yeah. I want to talk real quickly before we let you go about sort of that broader picture for the indexing market, because arguably, I think as we go into a different type of trading environment, people might choose to trade differently and invest through different products. Is the world under-indexed or over-indexed? Do you have any idea where we kind of sit? I can't think of a better sort of a viewpoint than your own to find out where we sit along that spectrum.
Yeah, that's a big question. I think the use of index is very popular and has found a new high level. Whether it will increase going forward, I think so, but it's difficult to predict. And at one point in time, there will also always be a need for active managers. There will always be a need for that. So what's the tipping point? It's difficult to say, but...
will we get closer to an answer after, say, a bear market? Will we know? Because there's so many people out there that say, hey, you just need a big drop in markets to find out the value that active managers provide today and where that equilibrium will sit.
But you're spot on. I think a correction in the market will actually tell us if we'll have a swing back to active managers. Time will tell, but I think you're spot on. The test will be when we have a correction in the market, a bear market, then we'll see if there's swing back to active managers.
Yeah. All right. We'll assess the equilibrium then. Bjorn Seaburn, great to have you. Great conversation. Thanks so much for joining us. Bjorn Seaburn, Executive Vice President here at the Nasdaq, the Global Information Services. We got a lot more ahead coming up on the TD Ameritrade Network. It's time for CEO Talk. TD Ameritrade's Tim Hockey is here with us in studio. We're going to talk about what comes next for the company after the acquisition of Scottrade and plenty more here to make sense of in these markets. We'll be right back on the TD Ameritrade Network live from the Nasdaq.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
TD Ameritrade Network goes to the Nasdaq.
Expect knee-jerk rallies too.
The voices you know.
They're selling upside calls to buy downside puts.
I think it's a fairly safe bet to bet on the American consumer.
The questions that don't get asked.
They have nothing to gain.
All markets, all day, streamed across all social platforms. Only on the TD Ameritrade Network. I'm Oliver Renick.
I'm Ben Lichtenstein. I'm Victor Jones.
I'm Kevin Hincks.
I'm showing you on the screen here right now the Nasdaq, the ES, the Dow, the Russell.
You can see the pop right there overnight.
This stock, best performing stock in the Dow. It's up 70%.
As an investor, you need to think about how this affects the overall business strategy.
People miss the boat in that they don't have a plan when they get in, and when the stock goes against them, they panic.
Think about the duration of whatever you are investing in.
We're going to look at the company profile on the mobile device.
If we can start to make it easier for our clients to work with us through modern technology, modern tools, and greater degree of investor education, then that'll be a source of growth.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain transaction. We create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
Welcome back to Morning Trade Live on the TD Ameritrade Network here in New York from the Nasdaq market site. Throughout this morning Trade Live, and this afternoon for Market on Close as well. But right now, I'm joined by Tim Hockey, the CEO of TD Ameritrade, here with us in the studio. Tim, great to see you again.
Good to see you too, Oliver. Good
Tim,
to be here.
There's been a lot going on at TD Ameritrade. Of course, the big acquisition of Scottrade, converted in February. Now over $1 trillion in assets, 11 million clients. What do you want to do with that? What comes next?
Well, obviously, getting the conversion done was a big deal.
Yeah.
February 24th weekend was pretty much textbook from our point of view. It's never perfect, because obviously there's a lot of clients that have their accounts moved from one broker-dealer to another broker-dealer. They didn't ask for that, so something changed. But from our point of view, all the planning led up to a really great win and a nice conversion that actually worked out beautifully from our point of view. Now, all of those resources that we had gearing up to that conversion weekend can be started to be tilted back more towards business in the future. So we're thrilled about our growth prospects and what our new Scottrade clients on our platform will do with us.
So every time, of course, a company closes an acquisition and you bring on new clients, the question then is, how does that manifest itself in the business? What is different? What will sort of be the metrics you want to look for to gauge that success, to say, this made sense to us, this works, this is a better place than we were before?
Yeah. So there's a lot of metrics, as you can imagine. Probably the number one is just client satisfaction. Are our new clients thankful that we've made this transition for them? As I said, they didn't actually choose this. So the way we would measure that would be literally just satisfaction metrics, but also be things like trade levels. Are they liking the new platforms? Are they liking the education? I mean, they now have access to the TD Ameritrade network, and they can see their trade techniques and being used on the platforms that they're now have available to them. So trade levels, client satisfaction levels, asset accumulation, all sorts of, and then there's of course lots of internal metrics that we would use in terms of are we getting the expense synergies we expected, the revenue synergies, all the things you would do in any deal.
We were just talking with Bjorn Seaburn about, I think, something very relevant to this conversation, which is how the smaller investor can kind of level the playing field. And I think in many ways that has been a goal at TD Ameritrade. What then comes next in terms of delivering those tools that small investors can use to kind of catch up to the big guy? We were talking about how the advent of social media creates data that is basically out there to be grabbed and harnessed.
Yeah, well, there's lots of threads we can pull on that one. The first thing is the Scottrade clients themselves, we knew were more retail-oriented, not as options and derivative based, so there's a great opportunity for those clients just to be exposed to our particular tools and platforms. But that aside, the more general question is, what's the future of the trends that we're seeing now, whether it be social media, whether it be technology? There are some just incredible things that are happening in the world around us that is driving behavior by our retail clients, and they want to have access to those instruments to trade.
One of the things we're talking about from the broader investing landscape with Bjorn, which I want to get your take on as well, is this idea of how market volatility sort of changes kind of the investing styles and where people go. I mean, my question was, are we under-indexed or over-indexed in that kind of passive market? I mean, how important is it to find out what the investing sort of landscape looks like on the other side of the volatility we're experiencing? Because a lot of people have not seen the type of trading environment that we see today. Folks that just participate in this bull market, this is something totally new for them.
Yeah, one of the things we ask ourselves all the time is, what are those long-term trends that you've got an entire generation of people that have never experienced? And as you said, there's been a secular decline in interest rates, a secular decline or increase in bull markets. So as a result, what we would expect is that people will sort of walk a little gingerly through the next little while. We saw the market activity, obviously, in February, first correction in many, many years. And so that's caused people to say, whoa, I guess things don't go straight up. Same thing we saw with the crypto phenomenon that sort of peaked in the December, January timeframe. It just went straight up. So you had a whole group group of people who their version of investing was buying cryptocurrencies and only went straight up. Of course, they became, very convinced that that's the only direction it could go until it started to go the other way. And you just don't hear as much about it these days because that's the phenomenon that happens. We see it over and over and over again.
I want to get your take on that because it really is fascinating. For me, looking at the market in January, there's something very unique that happened that for many hadn't happened throughout the bull market, which was a big degree of excitement from large to small investors, big flows into passive funds. Bitcoin rockets to 20,000. Was there sort of a coalescence of excitement around trading that started at the beginning of the year? What do you see from your perspective to know if those people that were interested in January are still interested? Because the crypto stuff is, we're going to talk about that later on the show, but by many measurements, it's slowed down, it's quieted. But does that necessarily have to bode the same for markets?
Well, I think that was a rather unique phenomenon, but it's not like it hasn't happened before in different spaces.
Sure.
We certainly saw that in terms of the sheer interest level in the sort of January timeframe. In fact, I was here at the CNBC event on TV, literally the day that the president released his tax bill. But the only conversation we were having, and I made a remark about it at the time, was
Bitcoin.
It was Bitcoin and crypto. I said, guys, give your head a shake. I mean, biggest tax break in 34 years or whatever the number was. All we were talking about is crypto. There was an imbalance of interest there. So no question, that drove a significant level of interest in trading, whether it be equity trading, but in this case it was crypto. But it introduced a whole new level of investors and traders to something that they were interested in. And so we saw it in our influx of new accounts, just a higher degree. Now, that will abate for a while, but something new will come along.
Sure.
Another big trend, of course, as we know, is the cannabis stocks. And that continues to increase, right?
That's what's because, and I'm glad you brought up the cannabis stocks as well, because that was something that also had that big influx of excitement. I guess what I'm trying to figure out is if that excitement will then translate into more traditional financial markets. I was joking because I was on Instagram the other day and I saw somebody talking about a post on how to make money on Forex, which is, it's one of these, another signs. Some will say, hey, this is a sign of froth, it's a sign of, excitement, but at the same time, that can very meaningfully translate into young people who haven't been engaged with stock markets and financial markets throughout much of this incredible historic rally, but now taking some interest.
It's precisely what you see. You get the euphoria at the beginning, a lot of interest, and then it just naturally dissipates, but you end up at a higher level than you were originally, both personally and as a market. I mean, think about it as, I don't know, getting interested in physical fitness. You might get all gung-ho right at the beginning, you go all, but then you realize, okay, I'm not as gung-ho, but you're probably a little bit more fit than you were when you started. Same thing with interest in the markets and investing in general.
One of the ways I think that has manifested itself also within TD Ameritrade's company is the 24/5 trading, which is obviously, I'm very familiar with the Lionel Richie. It's on our commercial, so I hear the songs a lot.
Very, very popular.
How has it changed the business? Do you see people engaging that? What are they doing when they are in that time frame?
Yeah, so clearly the world we live in is not 24 hours a day, 7 days a week. So just the opportunity to trade instruments, and there's not a broad number, as you well know, Oliver. After hours makes a lot of sense. It's relatively small in terms of the level of activity, not too broad-based, and of course, there's clients just need to be made aware of it, et cetera. We think it'll grow over time. One of our competitors matched us a couple months after we launched, and that's actually okay from our point of view. We think more investor awareness to have that trading activity available to them in those hours makes sense. And as a trader, why would you want to be locked out of the markets, 2/3 of the day?
Sure.
Doesn't make any sense. So we just think leading the charge on that was important.
Hey, it's easier for me too because I can check where ETFs are before the market opens. I want to talk about innovation technology because 24/5, a lot of things that TD Ameritrade has done to better communicate in terms of how they talk with actual clients and how clients can talk back and make orders and place orders through different venues. What are you most excited about as far as technological innovation in the world of trading?
Well, honestly, the thing I'm probably most excited about is the thing we talked about at the very beginning, which is at the same time as planning for this massive integration effort, which literally took a year, we said we were going to do it on we're going to run the business in two tracks. One, plan for a stellar integration but also keep the pedal to the metal on all of the technology innovation we were working on. So we're able to do that. So some of the fun stuff that we've done, 24/5 was a great one, of course, but our partnerships with Amazon through the Alexa, we were one of, I think, 10 companies that were with Apple in the launch of their business chat product that is just literally, I think it's an open beta test now, but it's coming to market very soon, and that'll be transformative. Our philosophy is, look, clients use these social networks. They use their all of the tools we didn't have 10 years ago, but now they're so integral to our life. We need to take our offerings and bring it to them. And so far, we've had some great initial success. Again, still small, like 24/5, as people become more aware. But you and I both know everything starts small, and then it grows to over time, and we can lever these opportunities to partner with these firms and add more and more and more over time. So we've got some great things in the works.
All right, good stuff in the hopper. Tim Hockey, great to chat with you again. Thanks so much for coming.
Good to see you, Oliver.
Tim Hockey, CEO of TD Ameritrade. We got a lot coming up in the second hour of Morning Trade Live here from the Nasdaq. We, of course, have those earnings on the way. But first, we're going to talk with another CEO of Churchill Downs. Stick around as we get moving. Hour 2 of Morning Trade Live from New York when we return after this short break.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets, born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
TD Ameritrade Network goes to the Nasdaq.
Expect knee-jerk rallies too.
The voices you know.
They're selling upside calls to buy downside puts.
I think it's a fairly safe bet to bet on the American consumer.
The questions that don't get asked.
They have nothing to gain.
All markets, all day, streamed across all social platforms. Only on the TD Ameritrade Network.
We just got married.
We're all under one roof now.
Congratulations.
Thank you.
How many kids?
My 2, his 3.
Along with 2 dogs and Jake, our new parrot.
That is quite the family.
Quite a lot of colleges to pay for, though.
A lot of colleges.
Okay, you get any financial advice?
Yeah, but I'm pretty sure it's the same plan they sold me before.
Well, your situation's totally changed now.
Right?
How about a plan that works for 5 kids, 2 dogs and Jake over here?
That'd be great.
That would be great.
That okay with you, Jake?
Get a portfolio that works for you now and as your needs change from TD Ameritrade Investment Management.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets, born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
TD Ameritrade Network goes to the Nasdaq.
Expect knee-jerk rallies too.
The voices you know.
They're selling upside calls to buy downside puts.
I think it's a fairly safe bet to bet on the American consumer.
The questions that don't get asked.
They have nothing to gain.
All markets, all day, streamed across all social platforms. Only on the TD Ameritrade Network.
So, Lionel, what does being able to trade 24/5 mean to you?
Well, it means I can trade after the market closes.
It's true.
So all evening long.
Ooh, so close. Yes, but also all
night through its entirety. Come on, all the time from sunset to sunrise.
Right, but you can trade
from darkness to light.
You're not gonna say it, are you?
Welcome back to Morning Trade Live on the TD Ameritrade Network here at the Nasdaq market site, where we are getting into hour 2 of MTL, 30 minutes into the trading session. We're talking about earnings that are on the way. Google is what we're going to focus on in just a moment. We got a lot packed in to the second hour. I'm Oliver Renick. Let's take a look at what is on that agenda. We're going to talk Google because earnings afternoon. We're going to see if they can lift the FANG group and perhaps provide a little bit of a buoy to stocks, which are trying to find their way this morning after starting off in the red. We're also going to take a look at some of the big items that are on the way, of course, for the overall market. And then we're taking a look at Churchill Downs. The CEO is joining us. William Karstanjian will be here after he opens up the bell here at the Nasdaq. We're going to have a great conversation about value versus growth. It's the penultimate question, if you will, of 2018. Will value performance finally catch up to growth companies, or is it going to continue to be a rocky ride for those trying to buy companies that got beat up? We're going to talk about how it incorporates also with the comeback in energy with two folks here. And then, of course, if we're talking markets, we got to get a little bit exotic. We got to talk blockchain and Bitcoin. Mark Yusko from Morgan Creek Capital Management is going to tell us about the recent acquisition and his search for $500 million of capital to fund blockchain investing. Aran Ayal is also going to join us to talk about the recent token sale and the future of crypto outside of course, just the digital tokens. We're talking about investment in blockchain-related companies and more. And then finally, I'm pretty pumped to talk with Wags. That's right. If you're a fan of Showtime's Billions, David Costabile is going to join us at 10:45 to tell us what it takes to be the most savage COO in the business, and maybe find out where exactly he gets all those lines and maybe a little market insight. We'll find out. Lots ahead. But first, I want to get a market update on what's trading right now and how we're holding up post-earnings, going to the Chicago TD Ameritrade newsroom. And we're also going to get from George Tillis, who's actually going to join us. Hey, George, good to hear from you, sir. Tell us what's happening in this market right now. Things are looking soft. Is the 3% yield a real deal?
It is, Oliver. When it comes down to the markets right now, they're really looking at that long-term bond yield, the 10-year yield, especially at 3%. Take into consideration, looking at the yields, 2.31 back in June 2017. So if it does break above the 3 area, some say it goes all the way to 3.5. You know, one of the things I would actually have to agree with JJ earlier. I wouldn't say it's going to go through that level quite aggressively at a rapid clip. We have to keep in mind, Oliver, there is some inflationary pressure out there. Trade sanctions and tariffs are inflationary. Weak dollar is inflationary. We also have to keep in mind that capacity utilization is tight. Labor markets are tight. So there's a lot of signs of some inflationary growth out there. We also have to keep in mind that the Fed itself is actually keeping the supply of 10-year notes or bonds out there very, very tight. So that's actually keeping the yields lower.
Hey, George, what I'm curious about, of course, is if the market's going to be able to hold on in the event that we break through that. JJ and Q and I were talking that how often have we been in this situation where we're now retesting 3% again, and we've got a slew of earnings. Is it a coincidence that all these things are lining up at once, George? Is the market going to be able to survive a 3% plus environment?
Well, that's the big question, Oliver. Is it able to sustain this? And it really comes down to whether or not, I would say, if the Fed actually starts to relinquish control of that long-term rate, they're actually increasing the supply considerably, Oliver, of short duration-based bonds. It's actually increasing short-term rates, but they've actually kept the lid on those long-term rates because they're keeping the supply of those long-term bonds very, very tight. It's keeping the demand for those higher and those yields lower. So, you know, the best of both worlds, Oliver, because you're actually getting policy slack. They're actually moving that short-term rate higher. They're keeping a lid on that long-term rate. It is creating some distortions from financial intermediation, especially from those financial institutions that are borrowing short, lending long. But that can only hold so long. So I think, you know, take into consideration what happens going forward in terms of what they're doing with those with the supply of those bonds on their balance sheet will make a big difference in terms of whether or not it actually breaks the 3 and starts to hold or potentially gets up to that 3.5 level.
Yeah. All right, George Tillis. We also had some data out this morning. I'm looking at existing home sales hit about 5.6 million. Pretty solid, better than expected. Not to mention the manufacturing part of that PMI number, pretty solid. But George, I got to move on because if I start talking economic data with you, we'll be here all morning. George Tillis, thank you, sir, for giving us the update live from Salt Lake City, TD Ameritrade Network Studios. Turbulence has characterized 2018. It's left few companies unscathed in the U.S. stock market. Even the seemingly indomitable FANG suite under a bit of duress. Scott Kessler, Director of Equity Research at CFRA, is here to help us find out if maybe that's going to change this afternoon. Scott, what do we need to see from Alphabet, Google parent company, to get this market excited about FANG again?
Yeah, so thanks a lot for having me here, Oliver. I think there are a couple things that people are watching for. You know, Alphabet has been able to sustain kind of a 15 to 20% revenue growth rate for a number of quarters. Yeah. So really people want to see that growth being sustained and indications that it will continue. I think secondly, people are really concerned about costs and expenses and whether they're thinking the company is going to have to spend more to grow more. Yeah. And then I think the third thing is really the elephant in the room, which is notions of regulation and legal issues. Obviously, we saw Mark Zuckerberg on the Hill, and people are wondering if that's going to have a spillover effect.
It's a black swan for tech at this point, right?
Yeah, well, I think it's more than that to some extent, because I think people are all anticipating that there is going to be more and more regulation. The question is what the impact is going to be, what the timing is going to be, things like that.
So here's the thing about Google that's so interesting is it's wrapped up in all the same sort of trends that we deal with the social media companies and Facebook, because if Facebook then has this movement and this stress around its core principle, which is advertising, okay, that's how they fund everything else. If then people come away from Facebook or they revamp the timeline, we're kind of blending stocks here, then where does that money go? Will advertising money go to other places? Will we start to get answers from that? Because Google obviously could be a potential recipient of that, or are these two separate beasts?
Yeah, so I look at this in a couple different ways. So I think the secular shift to digital will continue, and I think notwithstanding what we've seen over the last couple of weeks and months, that Facebook and Alphabet and YouTube will continue to kind of gain overall share. Okay. I think your question is, within digital, are there going to be shifts? Yeah. And I think it remains to be seen, but I do think that Google and YouTube in particular, especially given all the pressure around Facebook, probably are primed to benefit. The other thing to keep in mind, I think, to some extent, is what they say in the call relative to this issue. Have they seen a pickup? Okay. Are people concerned about their privacy a little bit more? How about spending and what the trends are there?
So you're bullish on the stock, a target of about 1,300. It was pretty exciting. I was looking at the picture they've got over here at the Nasdaq, the IPO of Google, which is about $50. So obviously it's come quite a long ways. Is Google a stock that will get thrown out with the bathwater if investors reassess growth and reassess how much they want to pay? Because that really is the sort of the key thing that I think about as we go into an inflationary environment, right? It's not just about bonds, it's about how much investors are going to pay for companies and what multiples they're going to pay. Does Google qualify as an expensive company by any standards?
Yeah, so I don't really think so. And if you look at the FANG names that you were referencing earlier, I think there's no question that Alphabet is the most attractively valued name, right? Especially if you look at the construct. So obviously Apple isn't necessarily in the traditional notion of FANG. Okay. But
it changes. There's double A's. Sometimes I go pharma, I throw in Microsoft.
Right. Yeah, no, I think that's fair. GAFA, I think, is another acronym that's thrown around in Europe. So Apple, without question, if you look at just PE and if you think the growth is sustainable. But if you're looking at kind of a stronger growth company, I think of the 4 original FANG names, I think Alphabet is by far the most attractively valued if you look at the PE as well as the growth. Yeah. I mean, the PE is kind of in the mid-20s, and that's really on a gap basis. If you adjust it, I mean, it's really almost trading at a market multiple, and the growth rate, as we were talking about, 15 to 20% over time. We think that's sustainable. So we really like Alphabet here. And the other thing to consider is with all the scrutiny and concerns related to Facebook, that actually, I think, is probably a good thing for Alphabet as folks look to shift spending or investments to that company from Facebook.
Let's talk cars, autonomous vehicles, and Uber, because we might get some actual numbers. We're expecting them for Google this quarter in terms of the valuation and what kind of exposure they have in this market that is private. So for some, I guess, that are more interested in Uber, they might get some answers. But from a Google's investor standpoint, what does that exposure to the auto space mean? What do we need to see this afternoon?
Yeah, so what you're referring to is Waymo and the fact that I think there's been a call for the company, the business, to disclose more and more information. And to be honest with you, I'm not sure exactly if or when they're just going to disclose data related to Waymo, but I think most people are starting to acknowledge that from a technology perspective, not necessarily from a consumer perspective or a hardware perspective, but in terms of the technology that makes autonomous cars possible, Waymo is really the market leader. And if they indicate anything around why they are the market leader or what the kind of data in terms of where they are in the progress of autonomous vehicles is, I think that could be a nice bump for the stock. A lot of people don't realize that Alphabet has a whole host of other bets within the confines of the broader business, and those really aren't valued or monetized in any real way at this point.
Let's talk other bets, because Nest is no longer going to be a part of that, and that means we're going to get a revaluation of what that part of the business is outside of Nest, which is now going to be under the overall sort of Google banner in terms of the way they break up the numbers. Is there a surprise that then could be important for the direction of the stock or the mindset of investors to see what all those other little pieces add up to without Nest, the home business?
Yeah, so when Alphabet was essentially created, right, it used to be Google and that's all people cared about. I think from an operating perspective, that still is the case. But I think people wanted to know really two things. One, how are those other business tracking from a revenue perspective? What's the impact? And then perhaps more importantly at the time was, what are the losses associated with those businesses?
Sure.
And so we have a handle on that at this point. I don't know if people are making investment decisions solely on Nest and how it's classified, or even to some extent what's going on with Waymo, unless Waymo indicates that there's some major catalyst on the horizon. Right now, those are nice kind of additive elements to the valuation story, but for us, it's really strong growth, continuing attractive valuation in the core business. Everything else is kind of sprinkles on top, if you will.
A good note to leave it on. Scott Kessler, excellent analysis as we get ready for those earnings this afternoon. Alphabet set to report. Scott Kessler, Director of Equity Research at CFRA, giving us the rundown on what to look for. Thanks so much, Scott. All right, we got a lot ahead. Coming up on Morning Trade Live, we're going to talk about what is in store for Churchill Downs. May 4th to 5th is the Kentucky Derby, but the stock's got even more going for it. Here's a chart. It's not a tech company. It's not maybe one of those companies you know about. We're going to talk to the CEO, though, in just a second about what's behind that big move. Stick around when Morning Trade Live returns.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
TD Ameritrade Network goes to the Nasdaq.
Expect knee-jerk rallies too.
The voices you know.
They're selling upside calls to buy downside puts.
I think it's a fairly safe bet to bet on the American consumer.
The questions that don't get asked.
They have nothing to gain.
All markets, all day, streamed across all social platforms. Only on the TD Ameritrade Network.
We just got married.
We're all under one roof now.
Congratulations.
Thank you.
How many kids?
My 2, his 3.
Along with 2 dogs and Jake, our new parrot.
That is quite the family.
Quite a lot of colleges to pay for, though.
A lot of colleges.
Hey, you get any financial advice?
Yeah, but I'm pretty sure it's the same plan they sold me before.
Well, your situation's totally changed now.
Right, right?
How about a plan that works for 5 kids, 2 dogs and Jake over here?
That'd be great.
That would be great.
That okay with you, Jake?
Get a portfolio that works for you now and as your needs change from TD Ameritrade Investment Management.
Welcome back to Morning Trade Live from the Nasdaq in New York City. The TD Ameritrade Network is going on the road today. This chart, the stock chart we just saw before the break, To pull it back up again, guys, we're looking at the chart for Churchill Downs, a $3.5 billion company, and owner of the Kentucky Derby, whose shares have rallied almost 50%, there it is, in the past year. And it's not entirely just about horses. Bill Karstanjian, the CEO of Churchill Downs, just rang the opening bell and joins me here at the Nasdaq. Bill, thanks so much for coming in.
My pleasure.
I guess you were already planning to, so it's great to have you.
It's great to be here. It's always fun to come to New York.
So a couple weeks before the Kentucky Derby, May 5th this year, what's on your mind? What is most exciting to you? Because I know obviously a big event that everyone associates you with, but you guys have a lot going on outside that as well.
Well, we do. We're a diversified company, so we have a number of business units that are going 365 days a year. But this time of year, it's about the Kentucky Derby for us, always trying to keep it an iconic but fresh event.
Yeah.
We're lucky in that we have this event that's been around for 144 years, so we stand on the shoulders of giants who built it in part to what it is today. So every year we want to keep what's best about our traditions, but also add a twist. And so this year, as we've been doing recently, we have a couple major renovation projects going on within the facility that we hope the customers will love.
And what will that entail?
Well, a couple of them. First is a massive renovation in terms of the construction of a new tower of luxury suites.
Okay.
So another 1,800 seats right on the starting gate. We're excited about that. But then also we decided to bite the bullet. If you've ever been to Churchill, you realize it's in an old neighborhood. Mm-hmm. So there's a limitation on parking and land. So we couldn't make that many more parking spaces. So we redesigned the entrance of the facility and the parking infrastructure to create an incredibly efficient bus service to take people to and from the facility.
Sounds like you're expecting a lot of folks this year.
You know, I hope we set the record, but it's always a bit weather dependent. But we always get between 155 to 170,000 plus people on Derby Day.
Weather dependent, I imagine also, to talk a little bit more macro with you for a sec, because I think your business is uniquely sort of poised to be a recipient of a strong economy, people making more money, and maybe I got some of the answer, the fact that you're building out that luxury suite, the tower, but how important is the strength of the economy to your business? Are you watching the wage numbers? Are you watching the figures like everybody else is with an extra sort of bit of scrutiny?
Well, we're in the discretionary income business. Yeah. So whether it's the Derby where seats go for essentially around $100 general admission to $12,000 per seat, everybody that's there is there because they want to be there, not because they have to be there. We're not selling a necessity. We're selling an experience, and we're selling a discretionary income item. So the economy is always important to us, not only for the Derby, but for our entire company. You know, we also we own 9 casinos. Yep. We own a large online wagering business as well. So all of our businesses involve customers making a choice of how they want to spend their free time and free money. So we do pay a lot of attention to the economy and try to make sure that we never forget the Kentucky Derby. It's not a horse race. It's an experience. Sure. It's a bucket list event. So our competition really isn't other horse races. It's the Super Bowl. It's the Oscars. It's all sorts of iconic American and world events. Yeah,
we were just looking at your company's chart, a pretty incredible run, so congratulations. How do you keep sustaining that growth? If you look at the company, it's got a fairly high multiple by most standards. Investors clearly are willing to pay you for the prospect of growth. So where will you deliver that to them?
That's a great question. Same answers we've had in the last number of years. We have organic growth built into our business units. Our Twin Spires online business has been growing consistently organically. The Kentucky Derby's been growing consistently organically. We've improved our casinos, whether they be greenfields or whether they be acquisitions. So we've had a nice philosophy and a nice process of organic growth plus greenfield opportunities plus willingness and ability to use M&A, mergers and acquisitions, where we see opportunities that fit within our family of assets. So we're humming on all those, firing on all those cylinders.
Within that M&A space, you sold the Big Fish games, and I'm curious, within the social space for gaming, though, do you still see opportunity there?
Social games, not gambling, but social games, is a huge market. It's only getting huger, but there's a lot of consolidation going on within that space. Yeah. And for us, when we look at what are we best at, where have we proven over time that we can be successful and outperform others, it's been more in the gambling and entertainment space. Yeah. So for us, selling Big Fish made sense because there were other companies out there in a consolidation environment that valued that business more than we responsibly could. Okay. But I think it's a great business and it's a great market. It's just our company's best suited for what we're doing now. Brick and mortar casinos, growing the Kentucky Derby, and our online gambling business.
The state of Washington recently declared that that type of online gaming constituted gambling. But on the big picture, do you see the environment, the regulatory environment, being open or more restrictive? I mean, what sort of battles are you fighting in that realm, or is it less so now without Big Fish?
Well, I think for our company, we've experienced what a lot of companies that are in the online space in one form or another have experienced, which is the law is constantly trying to catch up to commercial behavior. Commercial behavior is moving at lightning speed. There are all kinds of technology changes. There are all kinds of customer behavior changes. And the law is constantly trying to keep up. So there's constantly change and friction and uncertainty as the laws get settled. So the litigation you mentioned is a minor setback. We'll appeal that. We'll keep working through that. And having been in the online space for a number of years, that sort of thing can happen in that space, and it's just something you work through over time. So I think the regulatory environment, for me, I always look forward to the passage of time, because with time comes better clarity on the lines around operating that kind of business.
I want to talk about the future real quick, about perhaps where gaming will happen and how folks will do it. We were talking about online media and social media, but I'm curious also, does the rise of the crypto market mean anything to your business? Is there a way to, are you interested at all in what's happening in terms of the way now people transact in this new sort of environment?
Yeah, I've found when it comes to online, everything's relevant. You know, even if it doesn't impact our core product, which is gambling on horse racing and soon gambling and other forms of gambling online. Even if it doesn't impact your core product, it can still change the competitive dynamic of how people spend time. But also, it can affect payment processes. It can affect the technology around all of the different aspects of the business. So. All of us that are a part of running the company have to read pretty broadly, because we don't always have to figure it out in advance, but we need to respond very quickly when there are changes elsewhere in the online economy that will impact us.
Are you guys looking at this? Have you considered any of your gambling business? One day, can you envision them taking cryptocurrency as a form of payment when they put down a bet?
I can envision it, but it's not something that's in the short or immediate term as far as I can tell. So we keep our eye on it. We watch the regulators. We watch law, and we roll with it if and when it happens. There are a number of things like that we have to keep track of.
Yeah, if and when. Bill, thanks so much for joining us.
Oh, my pleasure. Thanks for having me.
Thank you so much. Bill Carstangian, CEO of Churchill Downs, just rang the opening bell at the Nasdaq. Up next, we got a lot more coming. We're going to talk about a big picture investing question that remains hanging over folks' heads on Wall Street. It's the idea of value ever catching up to growth. We'll talk about that and how it might play into a recent comeback, some strength in a market that had been underloved. We're talking energy. We'll be right back on the TD Ameritrade Network, live from the Nasdaq.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
TD Ameritrade Network goes to the Nasdaq.
Expect knee-jerk rallies too.
The voices you know.
They're selling upside calls to buy downside puts.
I think it's a fairly safe bet to bet on the American consumer.
The questions that don't get asked.
They have nothing to gain.
All markets, all day, streamed across all social platforms. Only on the TD Ameritrade Network. I'm Oliver Renick.
I'm Ben Lichtenstein.
I'm Victor Jones. I'm Kevin Hayes.
I'm showing you on the screen here right now the Nasdaq, the ES, the Dow, the Russell.
You can see the pop right there overnight.
This stock, best performing stock in the Dow. It's up 70%.
As an investor, you need to think about how this affects the overall business strategy.
People miss the boat in that they don't have a plan when they get in, and when the stock goes against them, they panic.
Think about the duration of whatever you are investing in.
We're going to look at the company profile on the mobile device.
If we can start to make it easier for our clients to work with us through modern technology, modern tools, and greater degree of investor education, then that'll be a source of growth.
Welcome back to Morning Trade Live, where we are at the Nasdaq in New York, the TD Ameritrade Network, coming to you from the market site as we walk through all kinds of topics. We're talking crypto, we're talking CEOs, but honestly, the market reporter in me is kind of most excited about discussing one of the perhaps hardest jobs of the bull market, which has been being a value manager. So-called value stocks have lagged high growth companies throughout the bulk of the stock market rally, but many see a rising interest rate environment in 2018. We're looking at it today, could potentially be that turning point. If you looped energy companies into that category, the last few weeks were pretty promising. I want to welcome in our panelist, Paul Ehrlichman. He's a portfolio manager and head of global value at ClearBridge Investments. Thanks for joining, as well as Tamar Essner, an senior energy analyst at Nasdaq IR Solutions. Guys, this is a great pairing because I think some would include energy within this space, but I want to start off with the move that we've seen in this area. Tamar, are you surprised by the strength with some of these companies finally catching up to crude in the past couple weeks?
Not surprised. We've seen that the underlying market for oil has gotten a lot tighter, so supply and demand are basically in balance. We also have a lot of geopolitical things going on around the world that have stoked prices higher, whether it comes to declining production in Venezuela, increasing tensions between Iran and Saudi, and potentially with more sanctions coming for Venezuela, Russia, and Iran. So that's stoked prices higher for oil, and as you said, energy has been an underloved sector for the last 2-3 years, so we're finally seeing the equities catch up to the commodity price.
Geopolitics a little bit rough for some stocks and the risk sort of on type trade, but for energy, as you point out, I think it's been a part of it. Paul, as a value investor, are you considering energy? Do you have exposure to this? How do you even go about sort of assessing either where this category falls? I can't figure out, are energy companies supposed to be growth because of how they're supposed to catch up some of the earnings growth, or are they value because they've been beat up so much?
Well, with commodities and energy, you sell them when they're growth stocks and the visionaries are running them, and you buy them when the accountants are running them. And right now, the accountants are running them.
What tells you that?
Well, I saw a survey of companies in energy as well as general commodities, and they just asked the people running them, what's the most important thing you're going to focus on? 50% said free cash flow. 4% said expanding capacity. I like that.
Now,
as an investor,
I've seen what's so interesting this past quarter. These are companies now that are giving back some money.
Yeah.
Dividends, buybacks. I mean, on the one hand, you look at just the way the earnings were sort of decimated from 2014 up until basically kind of where we are now. And you wonder, is it the best time? I mean, when you talk with these companies, Tamar, do they feel that they know their future strong enough to where they can start to give money back?
Their investors are demanding it. So they no longer want to see growth for the sake of growth. They want to see profitability. And overall, that's good for the macro environment. If these companies are not producing quite as much and we don't have as much production growth coming out mainly from the U.S., that will help the macro environment for oil prices if there isn't as much production growth that we don't need.
You talk about free cash flow.
Yes.
What would be the sort of metrics to tell you if these companies are doing it right, basically? Because it's a very different situation than a couple of years back where it was, hold on to your hats and, figure out where we can tourniquet the bleeding.
Right. So if you look at free cash flow, share repurchases, and I know this stuff hasn't mattered. As a value manager, the frustration has been fundamentals haven't mattered. You just hold up a shiny object called subscriber growth that everyone doesn't care about, free cash flow. But as people start looking for free cash flow, these companies have high fixed costs relative to total costs. You want operating leverage versus financial leverage. So we look at them and say, what percentage of your earnings, 40, 50%, what's your free cash flow yield, how much you're going to pay out in dividend yields, total shareholder returns. And if you look across commodities, you look across anything other than the FANGs or the fat bags as they're called, massive returns back to shareholders. And at the end of the day, all you're left with as a shareholder is free cash flow.
But we've heard this before, right? Because I started reporting it 6-7 years ago, and even then, I think it was around 2015, markets started getting rocky, right? We had a period of flat earnings, negative year-over-year growth. The market never went into a bear market, but it had some couple deep corrections, and I heard this is the time for value. This is why it's going to perform. And then once again, started to lag, even year to date. Even when the markets get rough, investors keep going back to those growth companies. What's different now?
Well, part of it is the time, but you're right. What we call the great distortion. I think every value manager didn't expect the central banks to push interest rates to 5,000-year lows and really distort the cost of capital. And then you had the momentum machines. That's the new mania. The new magic is momentum. Take over and passive investing. So you have this intertwined force that has been unstoppable. While none of this money printed, created, went to the real economy. Well, now the real economy is starting to improve. So you had assets inflated, volatility lowered, and the cost of capital suppressed. Now the real economy, look at nominal growth, look at inflation. If you look at things that are different now is if you look at commodities relative to the bond market. Measures of inflation, emerging markets versus developed markets. Everything has shifted. Value versus growth hasn't, because it's tough to get people to stop putting money into a passive growth fund that's dependent on 8 stocks.
Now, to come full circle, because you mentioned one word in the momentum, and my big question tomorrow has been if the market starts to weaken in some of the reliable places, like tech, like the social media companies and growth, what will then determine if 4 months from now we're talking about energy as the momentum companies? In the past couple of weeks, they started to get their feet under them. What do they need to do to get into a place where they are reliable market strength?
I think the market needs to see a couple of quarters of showing profitability and not lack of discipline. So I think that's been the big overhang in the energy space in particular, is that companies talk the talk about discipline, but then when you look at their actions and you look at what's gone on with the rig count continuing to go up, you look at hedging continuing to rise, hedging levels from the CFTC data, people are a little bit skeptical and saying, okay, well, maybe now as crude approaches $70, these companies are going to start to put more rigs to work and production's going to...
How does that look right now, that data? That's a great point.
So we're looking at some bottlenecks as growth really expands. You can only grow so far, so fast. You end up with infrastructure constraints. So I think that the market wants to see longer term how it plays out. I think that will be if oil prices are at 70 or above, we're looking at rampant production growth out of the U.S. That's going to be a problem for some investors.
Paul, final point real quickly because we're out of time. Will you be looking to oil as an indicator as to whether or not you want to build up your stake in energy companies?
We don't look at the oil price per se. We look at what price is discounted in the stocks. So right now the stocks are not discounting a sustainable increase in oil prices and cash flows. That's the opportunity.
Great conversation, guys. We got to leave it there. Paul Ehrlichman, portfolio manager and head of global value at ClearBridge, as well as Tamar Essner, senior energy analyst at Nasdaq IR Solutions. Great conversation, guys. Thanks so much. Up next, we're going to revisit one of those topics that we were just talking about. Bitcoin has been making a steady push higher in recent weeks, but what comes next for the blockchain technology and investing in this new digital market? Stick around. We'll be right back for another panel on the future of crypto.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets, born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
TD Ameritrade Network goes to the Nasdaq.
Expect knee-jerk rallies too.
The voices you know.
They're selling upside calls
to buy downside puts.
I think it's a fairly safe bet to bet on the American consumer.
The questions that don't get asked.
They have nothing to gain.
All markets, all day, streamed across all social platforms. Only on the TD Ameritrade Network.
So, Lionel, what does being able to trade 24/5 mean to you?
Well, it means I can trade after the market closes.
It's true.
So all
evening long.
Ooh, so close. Yes, but also all
night through its entirety.
Come on, all
the time from sunset to sunrise.
Right, but you can trade
from darkness to light.
You're not gonna say it, are you?
Welcome back to Morning Trade Live at the Nasdaq market site, live from New York City. We've got plenty more here in the last half hour of our program. We're going to start things off by talking about one item that's been making a steady move higher lately. It's Bitcoin. I guess it's all relative when you say high in that market, but it has been making that steady push higher in weeks. But the market for blockchain technology has extended well beyond the digital token in 2018. So to talk about the future of that technology and its role in financial markets in particular, are our guests. I want to welcome in Mark Yusko, CIO and CEO of Morgan Creek Capital Management, as well as Aaron Ayal, CEO of Shopin, a blockchain-based online shopping profile. Gentlemen, both of you have been on our program before on the TD Ameritrade Network. Great to have you here joining in New York.
Tremendous to be here. Thank you very much.
I want to start off, Aaron, just introduce yourself to us. Tell us about Shopin, because the last time we spoke, you guys were and still are in the middle of another public sale. Tell us about what you do.
Absolutely. So obviously we're running a token generation event, which is what you call an ICO for utility tokens. Yep. And we've thus far raised $41 million. So we feel very grateful, especially with the conditions of the market. And what we're doing is we're building a universal shopper profile where retailers give the users 3 to 5 years of their purchase data back to control, own, and manage. And when the user comes with this shopper profile to every application, web store, and site, you receive the most personal experience on every one of those sites, driven by incredible data. And more so, not only are you totally in control, but we can also send you adverts, and we give the entire ad revenue back to the users in a cryptocurrency called the Shopin token, which they can come spend inside participating retailers. So it's not just that we're driving higher conversions and data privacy, GDPR, all that kind of stuff. We're actually bringing the money that normally would flow out to Facebook, to Google, to other advertisers, and giving it back to the actual rightful owners of the data, the users, to spend back in the economy.
This is what I think is very cool about what you did and why I wanted to chat with you, because we've spoken about this before, and I think the timing is very appropriate given everything we're talking about with data. Mark, you've also had some pretty big developments lately. Tell us about what comes next after the incorporation of Full Tilt under Morgan Creek. This is very exciting. You guys are looking to raise about $500 million. How's it going?
Yeah. So I think we believe that if you break it into the three pieces: cryptocurrencies, utility tokens, and then security tokens. We think cryptocurrencies are great. We think they're here to stay, long-term opportunities in things like Bitcoin, et cetera. Yeah. Then you've got utility tokens. Shopin's a great example of something where you have a real need and what I love about blockchain is it inverts the value proposition or the value capture, whereas in the old protocol days of the internet protocol developers got very little. The application developers got all the wealth. This flips it upside down and lets the user recapture. We think security tokens is even bigger than that. Okay. And you think about everything of value in the world, right? This building, houses, securities, everything of value, we think, eventually gets tokenized. And so we're going to go out and raise a fund to be at the leading edge of that tokenization, hashtag tokenize the world.
So are you looking for then companies are you actually going to be investing in digital tokens, or are you going to be investing in companies that are building themselves around blockchain technology? I mean, we talk about the actual existing companies that have tried to pivot. I mean, where will you sort of draw the line?
We invest in cryptocurrencies in one place. Okay. We invest in ICOs and utility tokens and the companies that facilitate the development of those in a different place. But this fund will be dedicated to security tokens. So we'll actually be buying real things, real assets that want to tokenize and then go to a 24/7 global tradable format.
Interesting. So now, Iran, is this exciting from the perspective of somebody who is generating this specific new type of asset, to hear that there are now investors from traditional financial markets going in here? What will sort of separate which companies then become appealing to these types of investors? Which ones are sussed out? I imagine there's still a lot of this that's going on in the space. When you look around you, what do you see?
So when we look at this, you have to basically break down what is a utility token and what is a security token.
Right.
Utilities live in tokens live in very specific states. They're either a cryptocurrency, they're a security, or different types of utilities. For example, they can act as commodities. Ours acts as a commodity, or they can act as a certain type of currency within an ecosystem. So or a store of value. So you have to really assess what you're dealing with. But the really exciting thing about security tokens is that security tokens, with the regulations that are going to come in, make it possible for institutional capital to come in.
Okay.
Now, that is a benefit to the entire ecosystem, because you think that $850 billion is a lot of money. There's $16 trillion a day that passes through Forex. And that money needs to go somewhere, and they want to go into tokens, but they can't. Think about an HSBC private wealth manager. She can't recommend a token to anybody because it's not regulated.
Sure.
The moment it's regulated and custodianship is sorted out, you're probably looking at Q3 for that to be happening, just around the corner.
Okay.
You're going to see, in my mind, a flood that you have never seen before.
In terms of what? Just
in
money
terms
coming
of
into
the
space?
market cap, and in terms of actual companies, on companies that are already IPO'd, starting to ICO in interesting way and tokenizing not just their security offerings, but also tokenizing aspects of their business in a way that's absolutely compliant with all three major players in, such as the SEC.
Sure. Now, you mentioned in there that sort of timeline of what you're looking at, Mark. Do you have a timeline? At what point? Because I know that we've talked before with us, made analogies to the .com era and the rise of the internet. What timeline are you working on to see if all of this is real, if all of this will translate into something that's long-lasting, that has approval, that has sort of a regulatory aspect that is favorable?
Well, it's as you said, it is a timeline. And if you go back in history, technological revolutions or evolutions tend to happen over a 14-year cycle. 54 with the mainframe, 68 with the microchip, 82 with the personal computer, 96 with the internet, 2010 with the mobile net, or ubiquity of internet access.
Yep.
The internet of value, or this blockchain era, really is 2024. So between now and 2024, the next 6 years, there are going to be a series of incredible milestones, whether it be the SEC ruling that security tokens are fully compliant, whether it be custody being solved. All of these things are going to happen. And so what's going to happen is we're going to have this wonderful run between now and say 2022, 2023. Then the problem is we'll have a crash.
Yeah.
Just like in 99, 2000, the internet had a crash. But then,
so as you told us before, you still maintain that is yet to come.
Oh, that's yet to come. This last little thing that people talk about, that wasn't a crash. That was like a little blip. It was no different.
Worried some people, Mark.
I know. But it's people tend to look too short term. Like Bill Gates has the great line, right? People underestimate what they can achieve in 10 years and overestimate what they can achieve in 1.
Okay. A great quote to end it on. Real quick, Iran, yeah.
And really, what's really important is that if you have a look, for example, at the growth chart of Ethereum and the dip that occurred last year, it's almost identical to what's actually occurring right now. Now, I'm not a financial advisor. I'm not qualified to give financial advice. But it's very interesting to look at the history of Ether, which is not very long.
Sure.
And you have taken into account to look at where we are now and see potentially where things may go in the future.
Yeah. All right, we went a whole block talking about crypto without discussing and getting projections for the price of Bitcoin. Good job, guys. I think that might be a new record.
just look at Mark Yusko, and I put it out this weekend.
All right, there we go. Mark Yusko, as well as Aaron Ayal, CEO of Shop, and of course, Mr. Yusko, head of Morgan Creek Capital Management, CEO. Great conversation, gentlemen. Always good to get your take on this market.
Oliver.
Coming up next, we're going to talk perhaps about another under-known role. It's what it takes to be a COO, perhaps a very tough one. We're going to talk with David Costabile. If you recognize WAGs, you're going to recognize our next segment. Stick around right here on Morning Trade Live from the Nasdaq.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets, born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
I'm Oliver Renick.
I'm Ben Lichtenstein.
I'm Victor Jones.
I'm Kevin Dean. I'm showing you on the screen here right now the Nasdaq, the ES, the Dow, the Russell.
You can see the pop right there overnight.
This stock, best performing stock in the Dow. It's up 70%.
As an investor, you need to think about how this affects the overall business strategy.
People miss the boat in that they don't have a plan when they get in, and when the stock goes against them, they panic.
Think about the duration of whatever you are investing in.
We're going to look at the company profile on the mobile device.
We can start to make it easier for our clients to work with us through modern technology, modern tools, and greater degree of investor education.
Yep.
And then that'll be a source of growth.
Welcome back to Morning Trade Live on the TD Ameritrade Network here at the Nasdaq market site in New York City. So the question is, you think you can be a hedge fund manager? It's not just about stock picking. If Showtime's billions is to be believed, it also takes a lot of dirty work. To give us an inside look into how it's done, I'm joined by the COO of Axe Capital, Mike Wags, a.k.a. Wags, but best known as the actor David Costabile. He played Mike Wagner on Showtime's Billions. Great to have you here. Thanks so much for coming in.
Happy to be here.
Let's talk, David, about what it sort of takes to learn first to be a COO. Because you hear about these CEOs all the time, the guys who run the funds, the famous names, but who did you sort of take to figure out what their chief operating officer does?
Well, you know, a lot of what the writers, the producers of the show have had extensive conversations with everybody up and down the board. And they work very hard to not make it about one person.
Yeah.
Although I would have to say every single person I've ever met who's worked at a hedge fund believes that they are either Wags or Axe. And but then they usually say only the good stuff, which is hard to parse for me, which is only the good stuff and which is the bad stuff.
We were kind of joking before. I said, hey, maybe I could be Wags. Sometimes an anchor just has to tell it like it is. But then he said, are you comfortable and good at cursing?
Really just cursing in someone's face as much as you want, as long as you can.
Those lines that everybody loves, how much of that is written and how much do you bring in? Is there some David Costabile behind some of those lines?
Well, the writers know me very well, and the writers are excited to have me do things for them that they have not seen me do heretofore.
Yeah.
But it's all them. It's all the writers on the show, and they're great at coming up. I get all the best lines.
You do.
The snake gets the best lines. So
when you were prepping for this, you know, we talk about markets here day in and day out. Sure. It's complicated. There's a lot of sort of lingo and jargon that comes up in the show.
Sure.
Do you have like a little vocab sheet there? I mean, do you feel more in touch with markets? Do you understand more about them?
I do. I understand certain aspects of it. I almost could explain CDOs to you. I could almost.
Yeah.
Almost.
I think almost is basically what everybody aspires to. Even the guys that do, they really only almost.
So after reading Too Big to Fail, I was like, okay, I think I have it. I think after 700 pages, I think I have it.
Yeah.
Certainly while I was reading it, I had it.
Yeah.
And we have lots of financial advisors, people on the show who come and talk to us about what's going on, and then also now now that we're on the air, once you go to events and you meet people and you get to talk about different things, and you learn as you're going along.
It's interesting they say there's financial advisors on the set, because what I was curious about is if this show Billions will adapt to markets. And I think maybe an analogy would be the show Newsroom, which was very sort of plugged into current events. Do you feel that at all? Does anybody ever come in and say, hey, something's going on and we've got a great idea for this season? Because we talk about it every day and things are getting a little bit wild in finance.
Sure. I mean, you know, those guys are often the writers are very ahead of what's happening. Sometimes you'll see something on the show and you'll be like, it'll be happening now, but we made that. They wrote it 9 months ago. You know, it was a long time. We're a long time in advance, and so it's both, and they do spend a lot of time talking to people and visiting different hedge funds, and there are also lawyers on set and people who are advising them all the time about, because we want to get the lingo right. The best compliment for the writers too is that when people who work in finance come to be like, yeah, that's it, you got it right. It's a great compliment for us.
Have you ever had anyone big from Wall Street that maybe you don't know or you know, and they said, hey, I love you on the show?
Oh yeah.
Any
all
names?
The time. No. No way. All the time. I'm telling you, everybody I meet, you go to galas, you're raising money, and they're like, they come up and they're like, this is, and I'm like, what the hell is that?
They probably can't admit how realistic maybe your character portrayal is.
Exactly.
This season, you're deep into the third season, about halfway through. There was a really interesting moment, I thought, that was new for your character. Not too many spoiler alerts. A couple episodes ago, it takes place at a graveyard.
Yeah.
And Wags gets a little bit maybe existential.
Yeah.
What are we in store for? Is he going to start going beyond just the cursing, maybe?
I mean, I think, Wags is a deep person. You're playing bad chess if you think that Wags is only one-dimensional, that he's only got one dimension. He's a very deep thinker, and he's a very kind person. He's just not particularly kind to people he doesn't like.
Yeah.
He's not kind to everybody. He's kind to few. So if he's kind to you, then it's good.
You must be doing something right. Generating alpha.
Exactly.
What I started thinking about, though, is that, Bobby Axelrod, he's larger than life.
Mm-hmm.
He's meets many definitions of the quote-unquote alpha male, but he often will go and confide into people. That relationship is maybe somewhat tenuous, where you guys are you're supporting him, but in a very sort of official and professional way, right? You're going and making sure that his analysts are doing what they need, his traders are doing what they need.
Exactly.
Is there a life in which Wags would separate from Bobby Axelrod?
It's hard to imagine. It's hard to imagine. Why would we want to spin that off? We don't need to spin that off yet.
I think many people, including myself, knew you first from Breaking Bad.
Oh, yeah.
Playing Gale. And a really interesting character that in many ways I think is on opposite ends of Wags, but then I started thinking about that, and he was also a very calculating person. Maybe not calculating as he could have been.
That's true.
But there are some similarities. Maybe, am I crazy to think that there is something that you tap into just in terms of raw intelligence, perhaps?
Yeah, Gale is a very smart person, that is for sure. I don't think that he played chess as well as Wags plays chess. I don't think he's thinking about the game in strategy-wise. I think he's very focused on what he wanted and what he was able to make. But I don't think that we know because he got popped. Spoiler alert.
If you haven't caught up to speed.
Yeah.
Do you ever worry about Wags' future? Because I wonder, there are certain things.
Do you know something that I don't know?
I know that the
this sounds
SEC is
terrible.
going after, and I know the regulators want to take heads.
Sure. But they don't actually have a guillotine, so I'm not actually worried about my head popping off, which is good.
Your character, who in many ways I think is kind of a fixer, if you will, for Bobby Axelrod, for Axe. There were a lot of great fixers in television and film history. Mike Ehrmantraut from Breaking Bad. Sure. Maybe I think of Harvey Keitel from Pulp Fiction, his appearance. Were there other fixers that you said, this is the guy I want to take a cue from?
I mean, I think that the writers have very clear ideas inside of for who they are, for who they're the beginning of the model, and then it's sort of shifted in a lot of ways. In how it was originally conceived of that I was going to be the strong silent type. But then that was very clearly, very quickly, we understood that it needed to be the opposite, that he needed to be the outgoing, full expression of the id in a very over-the-top way. And that has been the most fun. So it's an ever-evolving sort of movable feast a little bit. And I think that the writers are very clever about how they write, not just the character, but they write particularly for me.
And within that note, how do you stay sort of always on point? Because Axe always needs Wags on point.
Oh, yeah.
When Axe hurts, you've got to fill in the gap.
Oh, yeah.
How do you get into that mindset where you have to always be on? Every line you deliver has to be crisp.
It's brutal, dude. It's brutal. So much pain, so much sweating, so much jumping.
Yeah.
There's a lot of jumping that has to happen.
All right, a lot of jumping to come on the season 3.
Oh, yeah.
Appreciate you joining us, David Costabile.
My pleasure.
Great chat and a great insight into being the most savage COO on Wall Street. David Costabile, also known as Mike Wagner, a.k.a. Wags, from Showtime's Billions. That's it here for us on Morning Trade Live from the Nasdaq. I'm Oliver Renick. Thanks so much for joining. We got plenty ahead throughout the afternoon. We'll be back here for Market on Close, but a short break. Thanks for joining. I'll see you then. TD Ameritrade Network goes to the Nasdaq.
Expect knee-jerk rallies too.
The voices you know.
They're selling upside calls to buy downside puts.
I think it's a fairly safe bet to bet on the American consumer.
The questions that don't get asked.
They have nothing to gain.
All markets, all day, streamed across all social platforms. Only on the TD Ameritrade Network.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. Nasdaq. Rewrite tomorrow.
I'm Oliver Renick.
I'm Ben Lichtenstein.
I'm Victor Jones.
I'm Kevin Hincks.
I'm showing you on the screen here right now the Nasdaq, the ES, the Dow, the Russell.
You can see the pop right there overnight.
This stock, best performing stock in the Dow. It's up 70%.
As an investor, you need to think about how this affects the overall business strategy.
People miss the boat in that they don't have a plan when they get in, and when the stock goes against them, they panic.
Think about the duration of whatever you are investing in.
We're going to look at the company profile on the mobile device.
If we can start to make it easier for our clients to work with us through modern technology, modern tools, and greater degree of investor education,
yep.
And then that'll be a source of growth.
We got a lot ahead of us at the TD Ameritrade Network throughout this Monday. We're talking earnings, markets. We're going to wrap things up when we get back here. 3 o'clock Eastern Time was when Market on Close special edition here from the Nasdaq Markets site will begin. We're going to talk a lot, from how to trade politics with Anthony Scaramucci, founder of Skybridge Capital, as well as a deeper dive into some of these big topics on earnings. We'll get an update from George Tillis on those companies that are on the move. And then we're also going to, of course, get an assessment before those Google earnings. Those are after the bell, but we'll see how the ones that are already reported hold up throughout the trading session. Stick around. A lot more. We'll see you this afternoon. I'm Oliver Renick. Thanks for joining Morning Trade Live. I'll see you here at 3 p.m. for Market on Close.